Hello, my good students. I trust that you're all well. Today's session, I want us to look at a question in April 2024, financial management. I know some of you will be like, Molimu, why should you wait for the results to be released? No, we must start our semester early enough because remember, also the time limitation is there, and that's why we'll be starting our semester. Actually, that will be on 2nd, which will be tomorrow. We'll be starting our semester tomorrow officially. We'll be starting our semester officially tomorrow. So make sure that whichever paper that you're doing and you're planning to do in August, make sure that you book this class as soon as you can. So looking at a question which was attested last sitting, that is financial management. And this is something that I've always been telling you that it will never miss, right? The concept to do what? Portfolio analysis. This concept is very key and it will never miss in exams. And if at all you can check this question, which was attested last sitting, I just want to share with you here. See, believing that it is very visible. If at all you can check part C of the question, of course the rest of the notes I shared with you earlier on, so I believe you have the notes as well, which of course the notes had these questions, definitely, the one that we shared earlier on. Part C of the question, we are told that the following information relates to two potential investments, namely investment M and investment K. Anytime I've seen investments, of course, the whole idea that should always tend to click at the back of our mind is the concept to do the portfolio. So I'm given investment M and I'm given investment K. You're given the aspect of probability and returns. Then, number one, the good examiner wants us to compute the expected return for each investment. Number two, determine the standard deviation of investment M and investment K separate. But still the question you're asked to compute the portfolio return, assume that 30% of the total wealth is invested in investment M and 7% in investment K. Look at such a question. You're given how many marks here? 8 good marks. These are literally marks that can take you places you've never seen before. So if at all I can take you back to portfolio concept, even before we start look at that question, you'll find that the whole idea of portfolio is all about what? It's all about investors, of course, diversifying their risks, whereby I'm investing in a group of assets, or we are investing in different areas. So bringing them together is what you're terming it as portfolio. And the whole idea of portfolio is all about risk minimization. If I can take you back, my good students, to what we did in class, where you notice that anytime you're dealing with risk, the concept of risk, of course, risk is all about that expectation that whatever that you are anticipated might not occur or might not be the case. So you'll find that we'll always be talking about these two forms of risks. Yeah, we'll always be talking about these two forms of risks, always. So assuming you're asked to draw a diagrammatical representation of the types of risk, assuming that question had asked that, right? So you'll find that I will always be talking of these two forms of risk. The risk, number one, is the one that you as an investor, you don't have control over the same. And this type of risk, ideally, you'll find that it affects the whole market, not only an individual firm, but literally it affects the whole market. And these are what we normally refer to as, talk about systematic risk. So you'll find that below this point, right, regardless of the portfolio that you are holding, your risk will not be reduced. So in this case, you are terming this as systematic risk, right? Regardless of the portfolio that you form, your risk will not be minimized. Your risk will just be the same because it affects the entire market. Okay, so in that case, you'll find that your risk cannot be minimized by holding a portfolio. Then there is other form of risk here. You see, there is other form of risk here, which in this case you're referring to this as unsystematic risk. Unsystematic risk. What about unsystematic risk, my good students? Because we find that if at all we're looking at this point to be our risk, and this maybe is our portfolio. You see? So you'll find that the And systematic risk will behave in a sense that the more portfolio I hold, the less riskier my investment is. If I hold the larger the portfolio is, the less risk I'm going to have. So you'll find that portfolio concept is all about these concepts, which of course Mwalimu shared with us, and in that case in class we went into that in detail. The other key element that again we must always tend to remember anytime we read about portfolio analysis, my good students, are the methods. And these methods will never change. Wherever that you go, these methods will never change. These methods will always be the same. Number one, it will be important for you to understand that we'll be talking about, number one, expected return. We'll be talking about the expected return, right? Number two, we'll always be talking about the concept of variance. We'll always be talking about the concept of standard deviation, okay? And finally, of course, we'll always be talking about the concept referred to as what? Coefficient of variation. And I taught you this. Coefficient of variation. These are things that we'll always be having in mind, where for standard deviation, you'll be having in three components. Standard deviation, we'll be looking at it into three perspectives. Perspective number one is I am looking at standard deviation of a specific investment, that is return of maybe a certain return of an investment, or rather talk about a specific investment, right? We'll be looking at this on an aspect of a specific investment stock or a specific investment. Number two, standard deviation, will be looking at standard deviation of a portfolio. Standard deviation of a portfolio. Whereas, number three component of a standard deviation that you must always tend to have at the back of your mind is for you to determine standard deviation where you are not given the probability, with no probability. You should be able to understand how to determine your standard deviation with no probability. Expected return, again, we'll always be looking at it into two perspectives. Number one is I'll be looking at the expected return of a specific investment, or maybe security. Okay. Then I'll be expected also to understand the expected return of the portfolio. You see, and our question here wanted us to determine the expected return of the portfolio. I've guided you guys this in class, so I won't go deep into that. So, by the fact that you have mastered this, you'll find that handling any question for portfolio, it will always be very easy as a question that we want to handle now. This question, which was tested, of course, in April, okay, 2024, question number one. So I'd share that question with us and we've gone through it. So I just want us to handle it directly. So I'm going to share it again here on our screen so that we can be able to see it clearly. This is a question. Our focus is on part C of the question. I believe that part is very clear. So allow me to raise this point so that you can work it out very easily and quickly. Okay. Portfolio analysis, a very interesting area. A very interesting area. So after giving you the basics and of course flashback of what we did. So this question of ours, a good examiner, had given us a case there, and on this case he wants us to determine of course the standard deviation, or the first bit, you want us to compute the expected return of each investment. So I'm going to have these investments of ours here, whereby I'm talking of two investments. I'm having investment M. If I told you to look at investment M, these are the details given here. We're having probability, right, which is 0.3, 0.4, and 0.3. Given our probability, what about return? I'm given 20%. 8% and negative 4%. For K, we're given probability, which is of course 0.2, 0.6, 0.20. Whereas for aspect of our return, so this is return, this is our return, we are given 28% and negative 4%. My goodness, this is what I'm given. Literally, I don't need that question anymore, other than us looking at the questions. Number one case, you're asked to determine the expected return, right? Compute the expected return of each investment. So we need to determine our expected return. Expected return. This is one of investment of each investment, for us to be very specific, of each investment. I know very well that anytime I am looking at the expected return, all I should be having here in mind is that for us to determine expected return, I must have probability in this case, or in the event that I don't have, I also guided you on how to determine that in the event that you don't have probability. So by the fact that I was given probability, this will be easy. I'll be taking my actual return times probability. All this, I just need to do it to sum them up. Nothing more. We are done with this, right? So like if at all we want to handle part or rather expected return of M, this will be easy. I'll be having 0.3 times 20. We add 0.40 times 8, right? We add 0.3 times negative 4. Don't forget negative. So that expected return I should be having 0.3 times into bracket 0.3 times 20. We add of course 0.4 times 8. We add of course 0.3 here times negative 4. Don't forget negative. That's why you're given there, right? So that should give us of course a figure of 8. Expected return of K, the same case I should be having my probability 0.2 times our return, which is 20. We have that should we're given the same values, right? We're given the same, correct? So I'm having of course we add 0. This is now 0.6 times 8. Then we have 0.2 times negative 4. See? So this should give us what? This should give us a value of 0.2 times 20. We add 0.6 times 8. We add 0.2 times negative 4, which in this case I should be having what? Again 8. Kindly confirm if at all we are getting the same values, right? 0.2, 0.6 and 0.2, where we're having of course 28 and negative 4, 28 and negative 4. So this is what Mwalimu is getting, right? 0.2 times 20, just for confirmation, 0.6 times 8. We add, of course, 0.2 times negative 4. So we are getting 8. After that, we are through with this part. We proceed to question number 2. What did the examiner wanted us to do? The examiner had asked us determine the standard deviation of investment M and investment K. So, number 2, the good examiner wants us to determine the standard deviation, right, of each investment, not of the portfolio, of each investment. So, once I've seen the standard deviation, of course, I should know very well that I can't work out standard deviation unless I'm having what? Our variance. Why? Because standard deviation is just the square root of variance, and our variance is a summation of return minus our actual return, in this case we square, times our probability, right? Times our probability. Then we introduce what? Square root. That should give us our standard deviation. This should give us, of course, our standard deviation. Or in other words, you normally tend to take it as what? Square root of your variance. Square root of your variance, as simple as that. So if I told you to check this question here, see how this will be very easy, and you're going to agree with Molimo that this question is, we were supposed to get all the marks, all the marks. So at this point, let us work out for each security or investment. We start with M. For M, at this point, all I'm going to do is to determine the square root of this, right? So the whole idea, or to make it much easier, I'm going to take, of course, our return, actual return, which is 20, right? Minus expected return, which is 8. I square that times the first probability, which is 0.3. Thereby, I'm going to have, of course, my actual return, which is 8, minus 8 squared times probability, which is 0.4. Thereby, I'm going to have the last one here, which I'm having, of course, negative 4 minus 8 we square times probability, which is 0.3. So that at the end of the day, what will I be having here? What will I be having here? We're just taking actual return minus expected return times the probability. That's what you're doing. So in this case, you can agree I'll be having 20 minus 8, of course, 20 minus 8 squared times 0.3. This will give me 43.2. I add, of course, 43.2. Let us have it step by step. That is 0, so this should give us 0. That should give us, of course, minus 4 minus 8 minus 4 minus 8 squared times 0.3. This should give us 43.2. 43.2, right? So plus 43.2, this should give us 86.4. 86.4. I need to do what? Square root. So square root of my answer, therefore, should be having my standard deviation, therefore, should be standard deviation of M. I'd be having 9.295. Standard deviation of M. Standard deviation of M. I should be having it at that point. I should be having it at that point. So once we have that, that should take us to, of course, the standard deviation of the other security, which is what? K. The same procedure my good students will apply. The same procedure, copy paste, we take our actual return, which in this case I'll be having 20 minus 8, we square, but this time round I'm going to multiply by 0.2. The other case I should be having, this should be 8 minus 8 squared times probability 0.6. Last one I should be having, of course, that should be minus 4 minus 8 we square times 0.2. You see? As simple as that. As simple as that. So this should give us 20 minus 8, of course, we square times 0.2, which would give us 28.8. 28.8. This one, of course, should give us 0, whereas the other one should give us minus 4 minus 8 squared times 0.2 to give us 28.8. So that as at the end of the day, plus 28.8, this should give us 57.6. If at all I determine square root of that, we can agree that our standard deviation, therefore, I should be having 57 square root of my answer to give me a standard deviation of K. We are going to have 7.5 589. See, as simple as that, you're through with that. Now, the most interesting part, look at this case. You're given 3 marks. You're given 3 marks here because their part, the examiner wants us to compute the portfolio return, assuming that 30% of the total wealth is invested in investment M, whereas the other one is K. So, portfolio return, right? Portfolio return. If at all you can recall what Mwalimu guided us, portfolio return. Anytime we are talking of portfolio return, of course, we must always remember this, that for me to determine my portfolio return, I'll always be having the weight. In this case, I'm having weight of M times the expected return of M. We are going to add weight of R times the expected return of R. A good examiner has told us that we'll be having weight of M and weight of R, which you're given there in our question. We're told that at this point you're going to invest 30%. We're told very clearly in our question that 30% will be invested in, that should be M, right? We're having M and K, not M and R. We're having M and K. This is K, this is K. M and K, M and K, M and K, M and K, not R, M and K, right? So, at this point, we are told that based on our question, 70 is going to be invested, 30 is going to be invested in M and 70 in K, right? So 30 in M, 0.3 in M, 0.7 in K, given our weights. So we can agree and say that therefore my portfolio return therefore should be the weight of M, which is 0.3. Have we determined the expected return of M? Yes, we are determining the expected return of M, which was 8. So 0.3 times 8. We're going to add weight of K, which is 0.7. Had we determined the expected return of that is of course M? Had we determined for K? Yes, we're determining expected return for K, which was still 8. So times 8 here. So in this case, my good students, what are we going to get as our portfolio return? Portfolio return therefore will be having 0.3 times 8. We are going to add, of course, 0.7 times 8. So this should give us what? This should give us 8 average, right? Should take us back to 8. Should take us back to 8. So therefore, my portfolio return, I'm going to have what? 8. Remember all this, if at all you want to put it in percentage, that is okay. They are in percentages, right? So at this point, these are what you expected to do in this question. This is what you expected to do in this question, as simple as that. As I told you guys, remember that our classes have already commenced, or rather will be commencing on 2nd of May. So if at all you are doing any paper for CPA, and you want to start preparing early in advance, don't wait for long. You start your classes as soon as you can. And as I've always said, once you've started early enough, you'll find that you're going to reduce pressures towards the end. So take this chance and reach us out. 0708 068 851. Make sure that you're starting your classes early enough. We have 2 packages, pre-recorded version and we have live virtual classes. For live virtual classes, so it will be starting on 2nd of May. Make sure that you're joining these classes, guys. So this is what we expected to do. Of course, next class, we're going to do another question, actually, just on the last sitting paper. There's a very good question of loan amortization. Let us do that question in our next session. Thank you guys. See you then. Bye bye.